Hi, and welcome to today's session of Lunches with Legends, where we connect with some of the most illustrious individuals in the financial service world while supporting vital healthcare organizations in our communities. So before we begin, I'd like to thank the key sponsors of this series, especially our gold sponsor, KPMG. We're deeply grateful to KPMG for their friendship and generous support. We'd also like to recognize our three silver sponsors, RPIA, Ventura Realty, Creek and McConnell Group, as well as TD Bank. So we're so appreciative of your generosity. I want to remind everyone that 100% of the dollars you donate today through Lunches with Legends goes towards pediatric mental health in our community. So if you have not already made your donation, please take a moment, go to the donation page on the site. Naturally, we'd greatly appreciate everyone's support. Ladies and gentlemen, I am so excited for this conversation, and it gives me great pleasure to welcome our distinguished guest, Ms. Jenny Johnson. Jenny, thank you for joining us.
Thanks too. Thanks for having me, Mo. This is great.
All right, fantastic. So let's dive right in. Jenny, we were just talking a few minutes ago. You are now the third generation of the Johnson family to lead Franklin Templeton. Can you maybe walk us through your background, how you became interested in the family business, and what you learned from your predecessors?
So while my father is second generation, the reality is his father had a brokerage business, and his older brother ran the brokerage business. And my father wanted to do his own thing. So he was about 24 years old, and he said to my grandfather, "I'd really like to take this little Franklin Funds subsidiary and run that myself." And at the time, it was $2.5 million in assets and a part-time secretary. And so he really built the business. And so growing up, it was a really small business. I think it was in college that somebody pointed out how big it had grown. I always thought of it as kind of the struggling small business. And so for whatever reason, I'm one of 7 kids. I always had a desire to work in the business. I'm not sure what attracted me to it. At one point, all of us worked for the company, but I was probably the one who earliest on said that would be a career that I'd be interested in. And when I joined, I actually didn't go the sort of more standard route, which would be that people would join as investment people. I was completely on the operations and technology side, and I had run our e-business group, and then eventually took over distribution, and then the investment teams. And in that, I have to say, while it's a non-traditional way, so much of the industry, it does rely on that kind of foundation of good technology, good operations. And then, of course, at this time where there's such an important evolution going on, or revolution going on as far as data and technology's impact, it's great to have that background.
Yeah.
So that was kind of my path.
Well, and we're going to get to all those topics in a few minutes, but just before we go there, Jenny, last time we spoke, I learned that we have something in common. We both have 5 beautiful children. Where we differ is that you seem to have done a far better job of balancing the raising of those 5 children while managing far greater challenges and achieving far greater successes. So perhaps, if nothing else, but for my benefit, if you could share, what are some of the things that have helped you make all that possible?
Well, first of all, Mo, I'm going to have to tell you that I, at one point, ran a small subsidiary, an auto finance subsidiary. And I look at that as a time in my career that taught me the most about being CEO. Whether a company's big or small, you have the same problem. So I'm guessing you're building your business there is just as difficult as mine. I like to say I'm a second generation guilty mom. My mother had 7 children and then went back to college and then graduated from Stanford Medical School. So the fact that I stopped, I was actually number 6. And when I told my parents I was pregnant with my 5th and final child, my father, without missing a beat, said, "What if we'd stopped at 5?" So, I think in the end, like anything in life, it's about priorities. Sometimes home life pulls you more, and sometimes work pulls you more. And a strategy that I used to use is when I had a conflict, I'd think to myself, 5 years from now, when I look back, which of these 2 things is going to be more important? And that would often give me clarity where I would have to put my efforts.
Yeah, it's a beautiful way to look at things. And as maybe just before we get to the investment side of things, as a 3rd generation leader in the family business, the fact that you got to the third generation is an accomplishment. And obviously you've done some things right to beat those proverbial shirt sleeve to shirt sleeve dynamics. So can you share with us a little bit about your family's views on intergenerational transfer of wealth and some of the things that you're thinking about in terms of passing wealth along to the next generation from here?
So interesting. Again, I think one of the benefits to my being third generation is a lot of times the third generation is far afield from the struggles of building the wealth. In our case, while my dad was second generation, he really experienced a lot of those struggles. So I would say that kind of being at home, you were making the natural sacrifices and things that somebody who's building a business makes. I think my father, his number one worry now is how does he ensure that his grandchildren aren't a bunch of ne'er-do-wells, that they're productive in society. And he spent a lot of time building it's called the Grandchildren's Trust, but essentially if they have an entrepreneurial idea, they can submit a business plan and maybe get it funded. If they become a doctor, but they want to do a nonprofit, they could apply for the difference. So he's really focused on building strategies where there's not too much passed on and that everybody's productive. They get an extra lift, but everybody's productive. And I think the other thing is community service and donations to charities and things were always an important part of us kind of growing up, feeling that you have a certain responsibility around that. And I think he makes that very clear to the grandchildren as well, that we as a family have to stand by these values, and that all of you carry that responsibility.
Yeah, no, absolutely. So let's turn the conversation to Franklin Templeton, and tell us a little bit about Franklin Templeton, other than the fact that Franklin Resources is obviously one of the largest asset managers in the world. But how do you, when you speak to those that you meet with for the first time, how do you describe what you do and your company's role within the kind of wealth ecosystem?
Well, first of all, I have to say that I have to give my daughter credit for helping clarify to me how important it is that we describe correctly what we do. So I was asking my 5 kids, are any of you going to follow me in the business? And my daughter says, I want to do something that helps people. And I was like, are you kidding me? This is a business that helps people. We help people achieve the most important goals in their lives. Talk to somebody who doesn't have financial independence or is afraid they're going to lose their home in retirement or has a special needs child and is worried about who's going to take care of the child when they're gone. These are real things. And then, of course, I'm able to add, if you look at what's happened in this pandemic, it's public companies owned by our clients who did the innovation to be able to find things, like the breakthroughs with the vaccine. So, that's the first thing that I do in describing our business. And I think our industry should be describing it in our kind of mission-driven way. But we're an asset manager that we're 1.5 trillion in assets. We have 19 independent investment teams. We like to say that, when you're with Franklin Templeton, we're nimble where it matters because we're able to have these independent teams, but they're on a $1.5 trillion platform where we can invest in things like data science, technology, risk management, compliance. So you get the benefit of sort of the boutique manager with the strength of a real large manager. And we have investment feet on the ground. It really came from kind of the Templeton. As a matter of fact, little fun fact, John Templeton, the Templeton Growth Fund launched in Canada, I think it was 1957, was the first international or global fund in Canada. And his approach was he wanted to have investment feet on the ground. And so when we acquired Templeton in 92, it gave us kind of that capability. So today we say we have investment feet on the ground in 87% of the world's GDP. So we're a true global manager. And it's for us, we have clients in 165 countries. We think it's really important that you have feet on the ground, people who are speaking the language, reading the newspapers, understanding kind of the local culture and community to really be able to provide that kind of client service. So we're a true global manager.
Yeah, and you talked a little bit about the independent asset managers underneath, or the portfolio managers underneath. So, I think one of the most interesting thing is right as you stepped into the CEO role, within a year, I think I think it was within a year you basically led this successful acquisition of Legg Mason, which has its own very prominent history and culture. What stands out for you as you were bringing these two companies together? What comes to mind that speaks to what you just articulated a few minutes ago?
So first of all, we announced the acquisition about a week after I took over as CEO. I'd been announced as CEO, but from the date I took over, a week later, we announced the acquisition. So it was definitely trial by fire. Um, and it was interesting because, and then a month later, COVID hit and we were in complete lockdown. And a lot of people were skeptical. One, because of course the market dropped in March, was wow, is this the right thing? You guys, you did terrible timing. We never looked back. It was a growth acquisition for us. It was filling in product needs that we had. We're getting a different client base than we had. Even when it went down, we looked at it because asset managers don't tend to sell themselves when there's distressed markets because they always view that the markets will come back and there'll be value. So I think that's where there's a benefit of really kind of long-term, thinking where you're building a company for the future. And so regardless if you got the timing exactly right, as long as it was the right deal, then it made sense to continue to go forward.
Right. Interesting. And let's talk a little bit about, so historically, Franklin Templeton has been operating largely in liquid traded markets. That seems to be changing a little bit. And again, I guess that I'll ask that question in the context of, do you envision a more dramatic shift towards private markets? And if so, why? And where do you see and anticipate some of the greatest opportunities there?
So first of all, we like to say we're the sleepiest 127 billion alternatives manager, because in our 1.5 trillion, we have 127 billion. People usually don't appreciate how much we have in the alternative space. We have private credit, real estate, venture capital, and liquid alts. So anyway, why do I think that alts are important? You can see, and part of it is just the flush of global money into the system and markets, but that companies are just waiting longer. I think the regulatory requirements and restrictions on public companies has made it such that because there's enough private capital to carry them further along the growth curve, they're just waiting. They don't want to have some would argue burdens of being a public company. Mm-hmm. Our concern is the average investor. It used to be you worked hard. That was kind of the beginning as you were struggling. Then you had the growth phase, and then of course it starts to peter out a little bit here. Well, you're seeing these companies go public way further along in the growth phase, which means a traditional mutual fund customer doesn't participate in that. So we're big believers that we have to be able to figure out how to democratize the alternatives, because as long as that money's there, we think people will continue with this trend of staying private longer. SPACs are maybe adjusting that a little bit, but I don't think it's really going to change. I think that we have to figure out, as I said, to be able to democratize that, and that's why we want to have those product sets available. It can't just be that the wealthy get access to the growth cycle. That's bad for all of us.
Right. No, absolutely. So, I mean, you've referenced one, I guess, meaningful change in the industry, I guess, over the last 20 or so years. How have you seen the investment industry change over, or what are some of the other ways that you've seen the investment industry change over the course of your career? And how has that impacted the way you lead Franklin Templeton today?
Well, I would say in my 30 plus years in this business, there's been no period of time of change like we're experiencing right now. I mean, it's really unprecedented, no question about it. I'd say that the one thing that hasn't changed is I genuinely believe this industry takes very seriously their responsibility of trying to help our clients achieve the most important goals. The people I know in the industry, my competitors, I know the folks at Franklin Templeton, every day come in and feel a certain weight of responsibility on that. And I believe that hasn't changed. What's changed is technology is enabling, and there's, regulatory change. You see more fee-based, more transparencies around fees. So that's changed, and that's caused certain changes in distribution. But I would say the biggest is technology. And technology is changing in that active managers are going to have to leverage a lot of data to gain their unique insights for active management. And so they're going to have to be really exceptional at one, sourcing unique sets of data, as well as being able to apply analysis algorithms to be able to gain their insights. So I think that changes at the investment level. I think the delivery of how you provide your investment expertise is changing, and you're going to have many more separate accounts and less pooled vehicles. Because I mean, there's a fintech company in the U.S. that I looked at that for $5 you can pick which S&P stocks you want in your portfolio, and just they fractionalize it because technology can do that. Well, not that anybody really needs $5 of 10 S&P stocks, but it does demonstrate how you are going to be able to leverage technology to really fractionalize that. And so I think you're going to see more what was normally just the high net worth with tax efficient individual accounts. You're going to see that brought to a much lower level. And then I would say that the ESG component, people wanting to express their personal views, they'll be able to do screens overlaying those individual kind of mandates to be able to express, I like gender equality, or I'm, passionate about renewable energy, whatever it is, or carbon neutral. And so you're gonna be able to express those things in there. And then I would say, finally, I think blockchain is going to completely change. And, it's happening in little pieces, but it'll happen pretty quickly once it starts to connect to each other. It's changing the entire infrastructure of the capital markets.
So I'm going to double click on at least 3 or 4 things that you just you just touched on there. Let me start at the top. So the first thing you mentioned, just data analytics and data science. Just could you share with us how you've employed data science within your organization in any innovative or cutting edge fashion, for better outcomes for investors and some of your PMs?
So I'm going to give an example because I know it well, which was I used to do auto finance lending, and we used to, as we did loans to people, we looked at their debt to income, how long they were employed, residency, value of the car. It was very clear. There were like 6 pieces of data, credit score that you looked at and you made a decision.
Right.
Nowadays, there are lenders out there who somebody just goes online. And by the way, I asked my kids, would you go into a bank to get a loan? They looked at me like, why would I ever go in the bank? I just Google, I need a personal loan. And so as these sources where people are going direct for loans, our funds are buyers of those loans. And there's so much data out there that they look at micro signals. So for example, just the story that I know is if you don't capitalize the name of your employer and these like 3 or 4 other micro signals are with your account, then you're 25% more likely to have a loss. Now, you would never have imagined being able to do that kind of analytics, nor would you, it's one of those things where you have to just literally kick off AI to find those kind of micro signals. And the problem is, if you're doing lending in the traditional old way, the adverse selection that you're going to end up having is going to be a real risk that people, if they're not staying on top of it, aren't going to understand. So it doesn't matter what sector you're in, but there are going to be insights that you can find that help you inform you what is a better investment there, that I think AI is going to be really important to leverage.
Interesting. And, you touched on responsible investing or sustainability and ESG. And that has been obviously an increasing area of focus for investors. Other than customization and the fact that, so 2 questions actually. One is, do you see that shift occurring in private markets as well? In other words, that ability to customize and tailor to this. And number 2 is, are there any other trends that you are seeing with asset managers in that space?
In the alternative space, or
in the ESG?
Oh, ESG space. Sorry, ESG space.
Right.
So let me first address on the customization and the alternatives. This is where I think blockchain is so significant. So if you think about blockchain, and the worst thing that happened to blockchain was Bitcoin, because everybody thinks it's akin to Bitcoin, but think of it as this token that has all, if you are showing ownership for your home and you have a deed, it's all right there in the, a legal document. Well, that all gets stored in that token, right? And so now my ability to sell you my ownership is much easier. We don't have to go to the title company and go, get it all worked out. And so I think as illiquid assets become tokenized, the frictional cost of transition of selling them, transacting goes down, and you're going to be able to unlock customization. I can own a piece of a sports team, a building in New York City, whatever it is, because I can own these tokens, which will then enable a portfolio manager to customize a bit more. Art, you can imagine it. With respect to ESG, look, I think it's here to stay because I think people care about. I think people care about making money and doing good, right? You don't want to do bad. You feel bad if you make money and something's not good. But the problem is the data is not particularly good out there. And so, they have 5 providers. Well, there's more, but the top 5 providers actually only are correlated 57% of the time. So it just tells you that their data is not good, but it's getting better. And there's a lot of pressure for companies to be able to share their data on things like carbon footprint, gender equality, just a lot more data there that as companies share, I think that you're going to see more and more of that incorporated into investment decisions. And what you're going to see is traditional ESG was, I will take into consideration the risks associated with environmental, social, and governance, but it's going to, so that will always be there. And 100%, I think, of assets, a portfolio manager is going to have to describe those risks. Then you have what I think Morningstar calls this, kind of a sustainable fund. I'll overweight those risks with these ESG factors. And so I will, and particularly express those factors in my portfolio. And then finally, I think you'll have, impact, more flows to impact funds. I want to help climate change, so I want renewable energy, or I want gender equality. And there'll be specific funds designed with those outcomes.
You opened the door to crypto and blockchain. I wasn't going to go there so quickly, but I can't resist now. So first of all, maybe could you elaborate a little bit on the comment you made that the worst thing to happen to blockchain was Bitcoin, and I think secondarily, if I could ask you to just talk a little bit about specifically in your business, what impact is blockchain beginning to have, or do you anticipate having, and how are you navigating around that?
So let's hit the Bitcoin first. So Bitcoin is an expression, is an application of a technology, blockchain technology, right? The reason I think that that governments become excited about using blockchain, right? Right now, it's like, oh, the dark web had people using it, which was true because at that point you could open a wallet, a crypto wallet, and you could buy things in that wallet and nobody knew who you were because your wallet, unlike your bank account, didn't go through anti-money laundering and all the KYC stuff that is applied. Now what's happening is they're actually differentiating those wallets. There's clean wallets and dirty wallets. And the clean wallets are like a bank account. Everybody knows who you are. So governments are going to like that because number one, so what does blockchain do? It's a distributed ledger. So in other words, if a company wants to set up something on a blockchain, we act as a node or a ledger for a home equity company does home equity loans. So what happens is when they transact on a loan, everybody who's signed up for a node, they send everybody the source of truth. That transaction is sent to everybody. Every time there's a transaction done, our node is updated. So if a cyber security risk happens, that one's breached, but these other independent ones still have the source of truth. So it's going to be very important because I think a lot of we know this, that the future is going to be the cyber attacks. And so blockchain helps you protect that. And then the second piece is it's called blockchain because the chain is the transaction. And if it's a clean wallet, then you know exactly who did the transaction, and governments are going to love it because they can tax and they can follow where transactions are. So I think you're going to see more of that. And when I say, I actually think you're going to see a lot more countries expressing their currency digitally, right? Mm-hmm. So not to confuse it with blockchain. Blockchain is just, Mo, you and I have to agree that this blockchain token, this Bitcoin, sorry, I said blockchain, Bitcoin, that this Bitcoin token is worth X. It's like a piece of art. If we look at it and say it's worth X, we agree on a price. Unlike a digital currency that say is backed by the US dollar, you're backed by the full faith and credit of the United States government and all the taxpayers that have to do. So there's something behind that. They
Right.
will express the dollar eventually. And you see countries like China already talking and doing some pilots in digital currency. So I think that ultimately happens.
Hmm.
Where we think about using it is, one, as I already mentioned, from an investment side, as ownership and unlocking these illiquid assets. But
Right.
things like a back office. Imagine, you do a foreign exchange contract. Today, everybody, or a derivatives contract, somebody has to go in and look, is there collateral owned or not? Well, that gets programmed into the transaction. So it actually can settle automatically. So there's just going to be a lot of efficiencies that happen in back offices in our business. And there's a lot less reconciliation that has to happen. A lot of back offices are just systems reconciling to each other.
Right. Interesting. Very interesting. And just out of curiosity, amongst the 19 different, asset management groups under your jurisdiction, any of them engaged in any directional bets on cryptocurrency in any way, shape, or form?
So again, there are probably some portfolio managers that themselves would invest, but we are very focused on. We're working with the SEC right now. We had announced a stable coin dollar, so we're going to turn a money fund, and it's going to be coins on that. And so we're building kind of a transfer agency system and something called Stellar, which is a blockchain application. So it's the first sort of really regulated stable coin.
Right.
So we're more, again, looking at it from that perspective. We're not big fans. We do have a high net worth business, fiduciary trust, and they have clients who want to be able to hold cryptocurrencies, and you certainly hear people talk about it. And so they have to be able to support those kind of capabilities.
Right. Fascinating. Let me come back to something you mentioned earlier. You talked a little bit about the role of data and how significant it is for active managers. Maybe if I could just take a step back and think about where we've been over the last decade has sort of been punctuated by this huge exodus from active managers to let's so-called passive products, a variety of those. Whether truly passive or not, we could leave that debate for another time. But how do you actually see that trend unfolding, changing, reversing, etc.?
So, first of all, if I were to come into you and say, "Hey Mo, I have a great investment strategy. Here's what we're going to do. In the equity markets, whatever stock went up the most today, you're going to put more money into it tomorrow."
Right.
Now, then I say, and then I've got a great idea on the debt markets and fixed income. The companies that take on the most debt, you're going to actually invest more with those companies, right? That's what passive is. So why has it worked so well? Passive always works in a momentum market, right? And so we've had this environment. I mean, just thinking COVID. In the United States alone, the United States government has pumped $5 trillion, or by the end of the 1.9 because Trump did 2.2 trillion with his CARES Act. Then he did another 900 billion, and we're about to put another 1.9 billion. That money has to go. Interest rates are essentially zero. Where are you going to put your money when it comes in? So people end up, it goes right into the stock market, or it goes into alternatives, right? Because for the wealthy who can access alternatives, they put it there. That just constant influx of money tends to benefit a passive investment. Right. Interestingly, everybody talks about passive outperforming. If you look at the 10 years, it's only US large cap where passive consistently outperformed. In places like international and small cap emerging markets, you actually active managers outperformed 80% of the time over the 10-year. And so the analogy I want to leave you with on this is, how I think about kind of the future is, if I said to you, "Hey Mo, I want you to go buy a car, and you got to get safely from point A to B." And point A to B is a really well-paved straight road, no traffic on it. You're going to buy the cheapest car with the least safety features on it because you're measuring your cost here. But now you got to head to the mountains, and there's going to be a snowstorm, and there's no guardrails on the mountains, and you are going to wish you had paid up for those safety features. And that's what risk management is. And nobody in their lifetime ever has an investment experience that is a long straight road. But I can tell you the last decade, that's what it's been. But the next decade is going to be all about digesting. And none of us have ever seen this playbook before. All of the central bank intervention with a lot of money flushing into the system. And at that point, that's where I think active management becomes more and more important. And you saw a glimpse of it in November when people started getting worried about interest rates creeping up. And suddenly you saw the multiples in a lot of those high flying growth stocks start to squeeze down. The companies were doing great, but their multiples were coming down. So I think the next decade is going to be the decade for active management for sure.
I would agree with you actually, but it's fascinating how simply and elegantly you've laid that out. So appreciate the analogy. As one thing I forgot to ask you when we were talking about blockchain cryptocurrency and curiosity that I just didn't want to quickly come back to. You've seen the rise of tokenization and particularly what boggles my mind is this whole NFTs, non-fungible token world, where like a GIF of a fish goes for $600,000. And I just don't get it at all. But curious how you view this trend and the potential impact of NFTs and how that connects to your view on blockchain in general.
I mean, I'm with you. I have a hard time with it. But let's face it, people like exclusive access to something, right? So if I'm the only person that can ever have this picture of this fish, now I've thought myself like, well, so do you display it on your TV? Like, what do you do? So your friends come in and you know people have on their TV like the fire going or something. They just go, oh, that's my fish.
That I paid an insane amount of money for.
Paid an insane amount of money.
Yeah.
But to each his own. So I do think the technology does allow for the exclusivity and the protection around that. I personally am really trying to think through how I can go through my old photos and put them up for sale, but I probably won't be a buyer.
Got it. Yeah. All right. Let me take us a different road. And you mentioned gender equality earlier, and I was thinking as you were talking, you find yourself on the list of many of the most influential women in the world, among Barron's top 100 women in finance, as an example, and the many others. So in the context of serving as a role model to other women, how do you view your role as a successful CEO in an industry where far too many financial firm CEOs are male? How do you view yourself in that light?
Okay, I'm going to just add one more thing to the NFT so I can
lay
on that one. I just don't. There are values to NFTs on things like sports. If you got the winning World Series ball or whatever, it does show authentication. So there are some. I was too flippant on my response. There are some values. Okay, now I'll go with your question, which I'm not sure I think about it. I think every day. I think less about a woman in this business and more about a third generation I feel like I'm such a steward of this company. Our family's name is tied to it. And so I just want to, wake up every day and do what's right for our clients. My father always said, take care of the clients and the business takes care of itself. And, you just don't want to be the generation, you don't want to be the third generation that blows it. And so I'm just, focused every day on really trying to grow the business. I have to say that since I became CEO, I've done a lot more networking. You know what it's like with 5 kids. You're busy. I didn't have time when I was until now. They're 20 to 30, so they should be out of the house. They're not all completely out of the house, but they're certainly independent, so they don't take as much time. So I'm now having a fun time starting to network with a lot more people, which has been great.
Interesting. And so networking for you must be really interesting, and I'm actually curious, what that even means. And let me just again contextualize it for everybody because this may have been lost in translation. You have something like 12,000 employees in, I think you have offices in 30 different countries. You said you have investors in, I think you said 165 countries. So, maybe talk in the context of networking. Be interested in what that means to you. But I think beyond that, like what unique lessons have you learned managing people in this environment across all of these geographic locations? How does that impact your human capital strategy on a go-forward basis?
So first on the networking. So first of all, I differentiate meeting with clients. Like you have to do that. And I got to get back on an airplane and meet with clients.
Right.
Networking, I think of as industry peers who you can learn something. And if you build a trusted relationship deeper than just a transactional relationship, when you need to talk through something or whatever, you have that network there. And I actually, with a couple other friends, started kind of a group of women in asset management that get together, and we've been a great resource for each other. But networking goes men and women. I think you have to do both. And I am an introvert who had to learn to be an extrovert. And so it was not so comfortable for me to just reach out to people and say, hey, just want to introduce myself, would love to, do a Zoom call with you. And what I've found is people are really receptive to that. And so I forced myself to kind of do that on the networking. And then with respect to leading in this time, I remember, I think it was a priest who said that we're all in the same storm, but we're not in the same boat. And I think it was really important to have that perspective going in this, which is it just, one is we obviously saw it from jobs, right? If you were in the service industry, you were devastated. You weren't even sure you could make a rent. And so really brutal. And then the second were people who had jobs and were able to maintain them, but were ending up trying to educate their kids, and they're jumping, they're balancing kind of what that was. And then, for me, it was actually a bit of a blessing. I'm staying with my parents. I love it. I'm having so much fun. So, we all had different experiences. And I think it was important, one, to communicate what was going on as the firm. Here's what our plans are. Be honest that you don't know what the plans are. Make it clear to everybody that their safety was paramount, and have some empathy for people who were struggling with whatever it was, balancing kind of those home situations. And so I think empathy was an important component of it. And then, of course, you saw the social impact. We know that, socioeconomically, different communities were impacted much more than others. And so, and then, of course, had some terrible events that went on in the US. And so just, again, having empathy for kind of what people were experiencing. And as a CEO, being able to show maybe that vulnerability around that, that was a natural state for me. And I think it was pretty well received.
And again, just given the range of place in which you operate, like, again, what are some of you're really one of the first true global investors, or Templeton has been. And what are some of the challenges and benefits of operating locally in over 30 countries that you're finding in this environment?
You have to be local to really understand the mindset of an investor locally. And so even on the investment side, having somebody who's reading the paper, goes to business school with the leaders in the country. I mean, I laugh in India. I had to tell you, the guys all went to the same business schools all around. So they all know each other, right? So if you're not in that flow of information, you're going to have a disadvantage. And then being able to speak in your client's language, reporting in your client's language, being able to keep on the regulatory environment. We just find that the only way that we can effectively do it is to really be local. We just find it works better for us. So that's why we've been aggressive about making sure that both from an investment and a client service standpoint, we get local.
So speaking of local, I believe, you find I think Franklin Templeton headquarters are just a few miles from Silicon Valley. Is that correct?
We like to say we're in the heart of Silicon Valley. We might be sort of the upper edge, but we still say the heart of Silicon. If you include San Francisco.
Yeah. Okay. So let's include that. Yeah, let's include it. And so if you think about the impact of local on you and on your leadership team, so what impact has that had on you guys, and how are you seeing either technologies or fintech's influence on your business, maybe in ways that we haven't yet discussed?
I think, there's a couple of real hubs of innovation going on, right? So in the US, it's definitely Silicon Valley. It's Austin, Texas, some. It's, Boston's got some, right? So Israel's another great hub. So you have these kind of hubs of innovation. And so people who are interested in it tend to go there. So the fact that we're right there, what we did is we built 2 more buildings, and we put in an incubator. So we sort of made it clear to everybody, hey, we've got an incubator if you've got some, interesting fintech. And it's really opened our eyes to some interesting stuff that's coming along. So one is that I talked about the dirty and clean wallet, right? So one was a company that does security around a crypto wallet. We have another company that democratizes farmland. So an average investor who wants to have an allocation to farmland, they've figured out how, I believe it's on blockchain, they can, kind of tokenize that so you can have an investment in farmland without owning a farm, or you own a piece of it. We have one that is doing some work that came from the art world, and some trying to democratize some things around the art world. So it's when you're sitting there, and the nice thing about having this incubator is we probably review a little over 20 companies a month, and then decide which one we're going to both fund and put in our incubator. And so it's great just to have access to that. And you're also, from our venture capital fund, you're meeting with all these other VCs as you do deals together and stuff, and it just keeps you in the flow of information and how things are evolving.
Yeah, fascinating, fascinating. And just in terms of the valuation environment and sort of the growth of venture and late stage, sort of venture and pre-IPO shares. Do you have any views or thoughts on the evolution of that market? And you mentioned earlier that you're trying to democratize, that for private investors. And do you see that kind of actually getting to the retail investor? Like, do you see, and is there even enough opportunity to justify that much flow of capital coming into the space?
Look, I think there's going to be so much technology innovation that, think about the Industrial Revolution. A couple of things were figured out, and then people just kept building on it for years after. So I think we're still in the early innings when it comes to this wave of technological advances, and so I think it's kind of interesting time. So for an investment, that's always an opportunity. Our venture capital group is unique in that they sit with our public equity team, our growth equity team. And that has been very useful in that it has kept us out of deals, late stage VC deals, that when the VC guys are talking to, the sector analyst who's like, let me tell you why this doesn't make any sense. Look at the public valuations of these other companies. We've, been able to stay out. So I think you have to have that discipline. I do think that some of this private markets, there's so much money there, they're kind of buying from each other. But the reality check hits when they try to go IPO into a public market. SPACs may distort that a little bit, but public markets are a great disciplinary, measure of whether or not something's real. And even the public markets, as we talked about, because of all the money going into them, you see some really hefty valuations that are hard to justify if rates go up. But we would think that you would want, if you get into venture capital, not so sure that's critical, but if somebody wanted to get into venture capital, we like real estate, kind of as you walk before you run. So democratizing kind of real estate. There's REITs out there, but continue to do that. Private credit, but you would want to do it in a managed account, right? It's that classic. You don't want it running with scissors. Scissors are a great tool, but you want to be careful what you do with it. So ideally, when you democratize and open this up, you want to put it in a situation where it's a small allocation of a managed account that nobody can say, I'm all in, because maybe they don't understand the risks there and they don't have the safety net of other assets to protect them.
And so when you're looking at, and I imagine, maybe perhaps a little bit presumptuous here, that you're continuing to look at potential acquisitions, like Mason being, we talked about it, but how are you applying this lens that we've chatted about to other businesses, asset managers that you would be looking to buy, and you just, other than basic good business fundamentals, what are characteristics and traits that you're looking for, and how does this technology lens apply as well?
Well, we're very much focused on any acquisition being a growth story, not just a scale story, right? For those who want to just bring overlapping businesses together, squeeze out costs, we don't like that. We don't think that's better for clients or better for us. So any acquisition would have to be filling in a product gap that we feel we have. Probably the only real ones left are either local asset management in a particular market that we like, or private equity on the alternative space. So that would be one area. The other area that we look at it is what's happening to our industry is as financial advisors are becoming more wealth managers, what was historically really family offices who were providing those kind of capabilities for the ultra high net worth, technology is enabling that to come downstream a bit to the financial advisor to provide much more of a wealth management solution where they're giving financial advice, debt consolidation, whatever those are, and you leverage technology. So we invest in fintechs that are trying to solve that wealth management issue because it helps us build deeper relationships with advisors.
Mm-hmm. Mm-hmm.
So those would be the types of areas that we'd be looking
Right.
for.
Right. And just as these new acquisitions come in, I'd be curious, how do you view the cultural component? And I think that, Franklin Templeton, to my understanding, was born out of the values and philosophy of Benjamin Franklin and John Templeton. To what extent do those values, which were quite, notable, permeate the company today? And how has that culture, values, philosophy evolved, especially as you bring on new firms and businesses into the mix?
First of all, I like to remind people that that when they think of Ben Franklin, some people say, "Oh, he's got such an old image." I'm like, Ben Franklin was like the Elon Musk of his time when it comes to innovation. Like he was the guy. But when we do look, I always say the investment banker, when you're doing an acquisition, investment bankers are going to tell you why is it a great price, why is it a great strategic fit for the firm, and they never talk about culture. And it's our experience that deals live and die in culture. And when we were acquiring Legg Mason, because they had these 8 independent investment teams, honestly, we were a little bit worried, like, you're not just buying one culture, you're buying kind of 8 independent cultures.
Mm-hmm.
But because we had operated our own business with these independent teams, we felt like it would work. And we have been so pleased with the culture that we found from Legg Mason. So they had a line where they say, no chalk on your shoes. In other words, if you're playing a sport, don't get so close to the out of bounds line that you get chalk on your shoes. We now have adopted that. We love it, right? Like never, just work with integrity, do what's right for your clients. And you want to make sure that that's because you can't control decisions that are being made across the globe. So you just want to say to your employees, when you're making a decision, think first about what's right for the client, and then just ensure that you're working with integrity, and the decision, usually the clarity will be there. And you have to make sure that another firm believes that same view.
And how do you, and Jenny, as we're talking, what's clear is that you are constantly applying a very long-term view. As a public company, how do you balance kind of the short-term, responses and reactions and, of shareholders to this long-term perspective that you adopt?
I think this is where, because my family still, I think probably between founding families and employees and things, we're probably about 46% of the company. And so it really gives you the ability, when you've got that block of shareholders, it's hard for an activist to come in and, sometimes the activists come in with a very short-term view. So it's just kind of built in our DNA. Think about whether this is a right long-term investment. I mean, I can tell you right now, in China and India, they're two, tough markets, but they're great markets too. There's going to be 1 billion people enter the middle class in the next decade. 87% of them in Asia, and a lot of them are in China and India. And so for us, you just got to keep working at it to be successful there, even though it may not pay off for a long time.
Yeah. No, that's great. Jenny, I mean, you've shared a lot of interesting pieces of advice and wisdom with us. If you reflect on the best piece of advice or wisdom that anyone has ever imparted on you, what comes to mind? Sorry to put you on the spot.
Yeah. No, I can just tell you, growing up, it was all about persistence, right? There's a heck of a lot of talented people in the world that do nothing. It's all about if you fail, dust yourself off, get at it again, right? You miss 100% the shots you don't take. And so I think it was persistence. The golden rule, do unto others as you'd like to be done unto you. And so I actually think that kind of living a business career with those things in mind is, it's how you run your life and how you run your business. And I think those are great advice. And I would just, from a business standpoint, I always say I kind of live by the 4 Ps. So it is passion, purpose, uh, 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 persistence, and for whatever reason I'm forgetting the fourth. But it's that on people, which is the number one, right? Which is you always have to surround yourself with the right people. You got to love what you do, and you'll never work a day in your life. If you don't love what you do, you're never going to be great at it, because there's going to be somebody who loves what they do and they're going to just be better. It's not like work to them. Persistence, dust yourself off when you fall. And purpose, describe what you do in a way that people can relate. It's that, my daughter's question. I want to do something that helps people, and be able to talk about your business in a way that people understand why it helps people. Why does it matter?
And listen, and I think that you made a really salient point in terms of the industry understates how much how important it is to for people, for society, for helping people achieve their goals. If you take that purpose perspective, and you've been involved with a number of charities and philanthropic causes. Um, any favorites? Anything that has really impacted your life in any meaningful way?
Well, my son has type 1 diabetes, and so I was very involved with a Juvenile Diabetes Research Foundation. And, the second you have something personal like that, obviously that becomes a favorite. So that was a big one. But I actually recently got involved in a new organization, which is renovating the John Muir Trail, which goes up to California. It's absolutely spectacular, and it's fun. There's a great new leader, and she's just passionate about this. Is kind of her. She retired and said, "This is what I'm going to do." And then I would say the third one that's been fascinating is so Lucille Packard Children's Hospital is Stanford University's children's hospital, and I just think the breakthroughs that technology with data, and I just finished Walter Isaacson's book on the code breaker, which is on about the editing DNA and RNA, and ultimately they pivoted to help with these vaccines, and these are the ones who broke through and created the vaccines. But you realize that what we're doing with technology innovation and on the science side and medical is going to be amazing. I'm telling you, 20 years from now, people are going to look back at our medicine today and say it was a blunt instrument. They'll laugh at it. And what the pandemic did is it actually broke down walls, silos within universities, across departments, across universities, across countries, to work together. There's a website, I think it's called BioArchive or MedArchive, and people just post white papers, research white papers, and then they get crowdsourcing, other scientists responding. Think about the opportunities to break through with that. So I think it's an exciting time, and I see that when I'm on the board of the hospital. So it's fun.
No, that's great. And naturally, I mean, we're big proponents of healthcare here. The whole purpose of this Lunches with Legends is to raise money for healthcare and innovative causes. So, and particularly pediatric mental health. But so Jenny, this has been amazing. We've had a really far-reaching conversation, and I'm sorry to take you in 20 different directions, but I just couldn't resist. So a lot of the things we talked about were things that that preoccupy your family life, preoccupy the business, preoccupy your charitable. If I could close off with maybe asking you some of the things that you like to do for fun, or things that you do to unplug when you're not running a $1.5 trillion asset manager and chasing 5 kids and trying to help them build their lives, and all the boards that you sit on. What does fun look like for Jenny?
Well, first of all, my absolute passion is doing anything with my kids. So anytime they invite me to do something, I try to clear my calendar for that. But I would say my wind down, I have a ranch in Montana, and I have a couple horses, and there's no place that makes me, the second I get there, I just feel like I relax. Nothing makes me happier than riding my horse around the fields.
That's a beautiful sight, and I can completely understand why. Jenny, that was fantastic. Thank you so very much for joining us today. Thank you for sharing your incredible insights with us. I really can't tell you how much we appreciate your generosity of time and wisdom, and hope we can do it again soon.
Well, thank you for doing it, and thanks for letting me participate in such a worthy cause. So appreciate it. It's really my pleasure. And you're a great interviewer, Mo. You could adjust with anything.
Thank you. And for all our participants, thank you very much for joining us. If you have not yet donated, please do so by going to the donate page at the top right of the site, so we can continue strengthening pediatric healthcare and pediatric mental health in our communities. And Jenny, thanks again for your support of Lunches with Legends. We're so grateful for your participation and wishing you and hopefully everyone on the call a wonderful day.